From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. You're listening to the HPS Macrocast. This is Tony Fratto coming to you from New York City. John Fagan and Brendan Walsh from Markets Policy Partners are in the DC headquarters. Guys, we have a few things to talk about this week. It was a big trade week. We had earnings this week, but one thing I just wanted to jump into because this is unusual, and it sort of involves some of our sort of prior lives of releasing economic data and consuming economic data. The Bureau of Labor Statistics announced that the reporters who are covering announcements on Jobs Day, on non-farm payrolls day, who usually go into a secure locked room to receive the information, what the jobs numbers are, and then they release it at a specific time when the embargo is lifted. It's changing this week a little bit, where reporters are now not going to be permitted to bring electronic devices into that room, a laptop computer where you can write your story and push the send button when the embargo is lifted. How did you guys interpret that news?
Yeah, I mean, it's going to change the way the data is processed and traded for that first, say, 10, 15 minutes. Because before, you could bring your computer in and you had 30 to 60 minutes and you'd write it. And then at 8:30, which is usually when the data is released, the BLS turned back on the Wi-Fi and you could hit send. And then, up to your Bloomberg screen or your Reuters, and everybody reads it at the same time. Now you're still allowed to go in 30 to 60 minutes early, but you're only able to write it by hand. So at 8:30, all the reporters are going to run outside and
Back to the Future.
Yeah, and then they're going to have to upload it and somehow, but it's just going to take a lot longer. But the reason this will create a little bit of havoc is so much of the trading that happens in that first really 30 seconds, it's all artificial intelligence and the high frequency traders, but they use the data that, the technology that reads the report, and then, a robot decides how the trading is going to happen. So that this thing, basically, this new policy is going to completely eliminate that. I also think it was slightly, maybe a little bit politically motivated from the White House to Mike Bloomberg is also running for president, and he also still owns Bloomberg, and this is a big part of their business.
This is the way some people have been talking about it up here, up in New York, that this was a shot across the Bloomberg bow that the administration was trying to get at his business plan. It's hard to say what they're trying to improve here by doing this. The beauty of these kinds of these are called for not dealing with this. It's called a lockup. All the reporters go into the room. They're literally, essentially locked in a room that doesn't have electronic, doesn't have Wi-Fi. There's nothing to plug into. You can't get a signal from, outside the room. The Bureau of Labor Statistics gives them the information. They've got some amount of time, a set amount of time. And then there's a countdown, and the clock strikes whatever it is, and they can push send on their stories, and everybody's in the same boat. Everybody has the same amount of time to write their stories, to prepare if you're going to go on TV or radio and report it. The same amount of time to sort of prepare your script so you can do your reads on TV and when your signal goes live. So it's kind of a to me, it's like, people say, well, you mentioned, Bloomberg gets pushed through Bloomberg and other electronic,
right. It's not just Bloomberg
news services. Also, they're not the only ones. Reuters and others. There's traders and especially algorithmic traders on the other end of the line, not necessarily people, but machines that are getting that information very quickly and trading. And who's disadvantaged by that is what's really kind of hard to say. Everybody's essentially getting their information at the same time. Traders are getting the information at the exact same time. This case, if you don't let digital, reporters who are reporting digitally do this, you're actually giving an advantage to a different kind of reporter, and that's actually the TV reporters.
TV reporter, yeah.
Yeah, I mean, if you can't, if we say print, it's an old-fashioned word. It's not necessarily for print, like the New York Times or the FT. It's but people who have to put words on, type up their words and have them, edited and sent out. The TV guys don't have that. I'm a CNBC contributor, and see Elon Mui or Kayla Tausche or Eamon Javers, the DC reporters, will be there, and they will walk out the room with the script and be able to report it right off the bat, right off the top of their head. So it gives them an advantage over the other kinds of reporters.
And what'll be interesting to see evolve, because most people, you're not trying to trade the jobs number in real time. You take your time and read it, and most people are longer term investors. So for them, this doesn't really matter. For what it matters is those high frequency trading, the algorithmic. But that's also a huge part of the market now. But what'll be interesting to see is right now what they do is the algorithms read the print, and then they decide, okay, this word means good, so it buys. This word means bad. Whether they switch now to, instead of reading, they train the algorithms to watch the TV to trade off of it. That'll be kind of a fascinating.
That's I didn't think about that, but that's I could certainly see that happening. These are interesting. Look, some of these ways of delivering news are archaic. And so, why don't you just why doesn't the BLS just put it on its up on its internet page, or push it out on email, whatever. It's, truthfully, actually, those kinds of things actually are slower,
right,
and create more lines and differentiate different paces for getting that news than doing it this way, by giving it to a broad array of reporters and letting them all report it at the same time. You don't have this bottleneck at the website, or as if you've ever sent out a mass email. Your buddy gets it.
Yep.
Someone else might get it 10 minutes
10 minutes later, yeah.
Yeah, which is like a lifetime in trading land. So,
and you do see the website crash a lot on big days. It's you have to wait a long time.
The other thing I would say is that it's rare, but it has happened. When I was at the Treasury Department, we ran our press room, the Treasury press room, also served as the press room for the FOMC, for the Federal Reserve. Federal Reserve is not making news every day, so they didn't have a press room, full of reporters ready to go. So it was again, this is kind of archaic, right? But it worked brilliantly.
Yep.
We'd get a fax would come over from the FOMC. The two senior reporters together, it was usually a Dow Jones reporter and an AP reporter, would take that fax, not look at it, right? So flip it over, not look at the words, walk over to the copy machine.
This is great behind the scenes.
Yeah, make 40 copies of it, and then hand it out to everyone. And then, if someone like me, and frequently me, would be in the room, and they would tell me to start the clock. And I'd start the clock, and they would have 3 minutes to read the FOMC announcement. And there was a bell. I hope the bell is still there in the Treasury press room, even though they don't do this anymore. But there was literally a bell on the wall, and when the 3 minutes were up, you clang, 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 clang the bell, and you hear this cacophony of chatter, and it's the radio guys talking and the TV guys doing their stand-up, and reporters talking to their editors and pushing send on their stories and getting all that news out. And that was pretty good process. One of the things you said, now those were like FOMC announcement, pretty tight. They do get a little bit more time with the BLS report because there's a lot more news in there. The FOMC announcement usually just one page.
Yeah.
And most of the language is the same as the last FOMC announcement. So,
and Tony, now they do it over at the Fed.
They do it at the Fed now, and part of that is so they do that at the Fed. I think the Fed rightly should have their own place to do that, and they do it there. And but also since they started the press conferences over at the Fed,
it makes perfect sense.
You didn't want to have reporters in two places. Right. Reporters at Treasury, then they have to run all the way over to the Fed.
And that started under Bernanke, correct?
Bernanke started them, yeah. And and they used to be only for certain FOMC announcements. I think every other one, roughly. But now there's one after every.
Yeah,
after
just
every
recently we went to every one.
Yeah. So
which might be a bad thing.
Probably it is. It probably is.
Sometimes the less.
Well, you know,
as
what
a central banker, the less you say.
Yeah, but having a press conference after every FOMC announcement, what that saves you from is not having to have a special press conference for it, right? So you can't signal to reporters, they threw a press conference in after this FOMC announcement, because you can't just say we're going to have a press conference. You have to tell reporters, a day ahead of time, so they know to be there and to cover it and to bring their sound and audio people,
and then
so
the market's going to get wind of it and start freaking out about it. And,
so it was the smart thing to do. You do it for everyone. Whether you have big news or not, and so you don't have to signal anything. Well, we'll see what happens with this, and we'll see whether it works out, and whether anyone gets trampled running out of the room trying to get outside to.
This isn't going to blow up the markets or anything, but it's gonna create some funny stories, and also it kind of gave us
an adventure to Jobs Day, which is all we're interested in.
Exactly. Yeah.
All right, let's take a break there. We're going to come back and talk about earnings. Had a lot of big earnings reports this week. You're listening to the HPS Macrocast, and we'll be right back.
Hey Macrocast listeners, host Tony Fratto is heading to Davos next week, where he'll be giving us a first-hand look at what's going on at the World Economic Forum. Will you be there? Let us know. Send us an email at podcast@hamiltonps.com and follow Tony on Twitter @Tony Fratto to keep up with all the action.
All right, so there wasn't a whole lot of drama with earnings this week, but it was some impressive some impressive releases, it looked like.
Yeah, definitely. So far so good. John, why don't you kind of summarize it, the overall earnings?
Yeah, so we had basically this is the very first week of fourth quarter earnings season, the real unofficial kickoff, and it begins with the big banks. We had J.P. Morgan right out of the blocks on Tuesday with a very positive report, and that really pretty much set the tone. We had, there were obviously nuances in there, but Goldman was impressive, and
especially Morgan Stanley yesterday.
Right, and
they crushed it yesterday.
Yeah, they had a blockbuster report. We even saw some interesting stuff. Charles Schwab missed on their earnings numbers, but the stock went up anyway because they had all of this flood of accounts open because they moved to zero trading fees, and so it's another glass half full view. We had. Last earnings season, we had CSX, the rail giant, coming out and saying that they were very baffled by the economic situation. They issued last night, and it was they beat on earnings, although sales were a little bit light, and the stock rallied, and I think it's rallying in pre-markets this morning. And we've just had the tone has gotten better as we've come along, and the
only kind of slightly disappointing one was Target. Their holiday sales disappointed, but then the next day, the overall Retail Federation released their holiday sales, and that beat expectations.
Yeah,
so I think that's much more of a shift between Target and Amazon than it is an indicator of
that's exactly right. As we've talked about before, the sort of macro relevancy of the big box retailers has become a lot less. And in the old days, if Target or Walmart came out and said
disaster,
Walmart is still, because Walmart is now in both spaces, it's a little bit more macro relevant. It's a much better bellwether for the overall consumer. But Target coming out and saying we had a weak holiday, that's just not as scary as it used to be because the buying is migrated online. And that's exactly as Brendan said. We saw then a very encouraging retail sales number the very next day.
Yeah. I also think it's kind of interesting to compare where we are here in 2020 to the situation last year when we were receiving fourth quarter earnings, because a year ago the market was the world was very concerned about a global recession and the stock market was going to implode. Actually, the stock market at this point was down almost 25% from the highs.
Yeah, but it really was this. So the third quarter earnings season, which we got in October of 2019, of 2018, was the sort of starting gun of some of the real problems. That also coincided with Fed Chair Powell saying that rate hikes were on autopilot, and there was sort of a confluence of headwinds on risk assets at that point. But it was really that fourth quarter expectations had been slashed through that October to December period when markets were really coming down. Analysts were taking a knife to their earnings estimates, and then lo and behold, sort of at this time frame last year, fourth quarter earnings started coming out. They didn't look great, but they looked better than expected.
Yeah.
And that's really the key. And so when you see commentary, and we've seen it in this earnings season and previous quarters as well, which is, on a year-on-year basis, the average earnings growth for the S&P 500 companies is actually not growth; it's actually contracting. The fourth quarter is expected to be negative 2% year over year over the previous year's fourth quarter earnings growth. That doesn't sound great, but the way that earnings work, there are a couple of things here that make that not so bad. One being the fact that if you predict negative 2% and you predict a negative number, there's usually an upside surprise in there. It's usually not as bad as expected. Companies massage expectations lower, so there's a lower hurdle for them to leap over. Our old friend from Treasury, he's retired now, but Mark Sobel always this bothered him immensely. He called it market abuse, and he's got a point. They sort of cut and beat is what they call it. Make sure that analysts have a very low hurdle for you to leap over. So an upside surprise is important.
Well, how much of that? I mean, do you have a? And it's still early. And in terms of a sector, I mean, we've got some retail and all the big banks, I think. Do you feel is that in play here, John? Or
sure. Absolutely. So we've seen. Well, we only at this earnings season we only have 45 of the 500 S&P 500 companies having reported this week so far,
and mostly financials, which
right.
Trading doesn't give you a good indication of how the guy in Main Street's doing.
That's true. I mean, we see like a relatively high degree of earnings surprises. I think it's about 63% of the reporting companies have beaten the estimated earnings. That's actually lower than we've seen in previous quarters. We've seen like a relatively ridiculous degree of beats in previous quarters. Through most of earnings season, you'll have something in the high 70s. We've seen 80% of reporting companies beating. That's part of the reason why negative earnings growth on a year-on-year basis hasn't dented equity markets the way it might otherwise.
Yeah. And also, what you earned, you're looking back at this point. This was fourth quarter earnings. So the guidance that the companies give is a lot of times even more important than what they just earned, which, like Charles Schwab was a great example. They had actually a fairly wide miss, but when they said we just brought in millions of new accounts, and where we make the money on that is the spread, on their deposits. The market's not going to worry too much about what happened in the fourth quarter when 2020 looks very optimistic.
Strategy.
Yep, and that expectation for upcoming, that's another factor that makes a negative quarter of growth in the fourth quarter here not look that bad, which is the expectation is that we're really going to be picking up, and earnings are going to be picking up year-on-year growth in future quarters. In first quarter 2020 is supposed to be, I think, 4.5. It basically goes sort of 4.5 to 6.5% in the first half of 2020, exactly. And then it picks up. The expectation picks up from there, so that the expected growth for the back half of 2020 earnings growth year on year is low teens, 10 to 12%, and that looks a whole lot better. So the markets are leaning forward. They've also got the base effect. It's negative, but you have to think back that this is a year-on-year. The 2019 was compared to a 2018, which was flattered by the massive tax cuts coming through.
Right.
And so the earnings growth in 2018 created a base effect that made it hard for 2019 to look good.
Right. So then when we're leaving 18 and going into 19, when the market was having its large correction, the setup was basically exactly opposite of what it was.
Right.
The expectations for 2019 earnings had been very high, and they were in the midst of being cut. But analysts had cut too deep. So then when fourth quarter earnings came in, even though they were technically negative on a year-over-year basis, they were much better than the market was expecting. So instead of, where maybe 7 months before they thought it would be 8% growth for 2019, and it came in about 2%. But at that point, we were pricing in negative 5% growth.
Right.
Now, 2019 earnings came in fine, and there's a lot of hope that 2020 will also be fine.
But that's where we see the hurdle gets higher, and
yes.
It's going to be more difficult for companies to impress.
Okay. Let's we'll see. We'll be looking at the rest of earnings coming in over the next week or so. I know we'll have a lot to talk about next week too, with some big names reporting. Let's take a break. We'll come back and talk about maybe even what we're hearing from earnings, but just look at the global economy a little bit. We got some signals on the U.S. and the global economy this week. Let's come back and talk about that. Maybe talk a little bit about trades, big trade week. Yep. You're listening to the HPS Macrocast, and we'll be right back.
Are you a college junior interested in the intersection of economics, policy, and public affairs? HPS is now recruiting for our summer 2020 paid internship. HPS interns conduct analytical research, draft content for publication, interact with clients, and help on projects like the Macrocast. Learn more and apply by January 31st at hamiltonplacestrategies.com/careers. And to get a glimpse of life at HPS, follow us on Instagram at HPS Insight.
All right, Brendan, we got some global data and U.S. data this week. What are you paying attention to?
Yeah, this week has been quite good. Retail sales were quite strong. Though there was some downward revisions to September, October, but most importantly, December and November were revised up, and December came in quite strong, about 5%. Today, we just got housing starts data, which was up 16.9% in December, where the market
no one was seeing that coming.
The market was expecting it to be down 3-4%, and it was completely broad based, and it wasn't just. Sometimes multifamily can be incredibly volatile, so that can skew it. But both single family home starts and multifamily were strong, which is a really great sign. So the housing market had been fine in America for the last 4 or 5 years, but really it had been constrained by capacity. A lot of builders can't find enough workers to build new houses, so that was kind of slowing things down. So this could be a really, really good sign going forward. It was basically the largest monthly gain since December 2006. And then
we know demand is certainly there.
Right.
There's rents are up, and we know it's there's been a lot of talk, and we've talked a little bit about some of the urban housing problems. It's certainly here in New York. We see it, San Francisco, LA.
So the Northeast was up 25.5%. So, that's where you see a lot of the regulations that can constrain it. So that's a great sign. Also, we often talk about unemployment claims. So this week's data, which was last week's claims that checks were written, was down to 202,000, which is historically low. So the U.S. economy seems to be doing quite well. And then we also got some encouraging data out of China this week.
Yeah, some of the headlines have been a little bit mixed because the fourth quarter GDP was released, and it was expected to be 6.0%. And drum roll, please, it was 6.0%, right on the button. The Chinese statisticians do it again.
I think I even predicted that last week. Can I get some credit for that?
Wow. I mean, they just bullseye every time. Yeah. So that actually took the full year growth rate down to 6.1%. That's down from 6.6% last year. That's the slowest rate since 1990. So the headlines that you might see are, very slow growth in China. Well, that's, again, back to the sort of forward-looking aspect of the markets. The markets are not driving with their focus on the rearview mirror. They're looking at what's coming ahead. And at the same time they released fourth quarter GDP, they released important December data. We'd already gotten earlier in the week credit extension data for December, which was a pretty significant upside surprise. There was some statistical tweaks that went into added new aspects to that number, so it wasn't maybe as big an upside surprise as expected, but still in the stimulus upside surprising versus expectations shows that Beijing is, it suggests a stimulative intent by Beijing, who tends to let the credit markets off the leash a little bit, and so that portends for better growth down the road. December data was pretty much, whether you're looking at industrial production, which is a big upside surprise in December, retail sales, fixed asset investment, which is their big CapEx number, those were all uniformly surprising to the upside. That has added further support to the thesis that global reflation is underway here, and it's important that China's part of it. These are still off a pretty low base, and China has had to add more and more credit for less and less economic oomph. So the engine isn't necessarily as efficient as it used to be, given the debt overhangs and some of the other structural factors. But it's nevertheless it's another encouraging data point this week.
And to kind of make the point of how macro can affect both the micro and going back to earnings. So the U.S. economy is doing quite fine, but we're also seeing the rest of the world reflate. So that's kind of played itself out in the dollar. Basically, all of the S&P 500 companies are global companies. So a strengthening dollar is a huge headwind to their earnings, because it's just math, the translation from So the weakening of the dollar,
their earnings in dollars,
exactly.
So they may be earning in euros or whatever. Pick a country, rubles, and but you have to report that in dollars.
Right. So you might have sold $100 in Europe, but when you translate it back, it translates to only $95. Yeah. So now that the dollar's kind of stabilized, that headwind is flowing, or what used to be a headwind now has become a tailwind to S&P earnings, and that's helping the optimism.
China. Look over the long term, as China becomes a bigger and more mature economy, we're going to, whatever. At some point in the future, we're going to be looking at 5% growth in China and saying that's pretty good. They hit their mark. So I think we should, there's always double stories here that. They're not growing as fast as they used to, and so that's not a good thing. But they really ought not to have been growing as fast as if they're growing at 9%, it would be bonkers. So I think we are going to see some moderation over time as they become a more mature economy.
Right, and now, Tony, I'd like to get your take on it. I mean, the amount of money that U.S. companies are going to make because China, through the Phase 1 deal, has completely opened the doors, and it's going to be a free-for-all, right?
It's the greatest trade deal ever.
The greatest, most luxurious trade deal ever. There are going to be some modest improvements in this trade deal for China. Just take a quick look. So, we got the Phase 1 deal signed this week with great pomp and circumstance, probably more than what the deal deserves. And that's not to say that it's garbage. I know a lot of people are dunking on the deal. There are few. I like to see progress in the right direction on it. I like to see the fact that they're going to be restarting talks, that they're going to be working on a Phase 2 and a Phase 3 deal, whatever that means, and whether they get to it. But directionally, they're turning around and going back in the right direction of talking and negotiating on specific items and making public commitments. And that's not the worst thing. The worst things are, that this agreement, we in the United States desire a China that operates as a market economy. Let markets direct capital and resources and labor and fair prices for everything. But what this agreement does is encourages China to be more of a managed economy. It tells them, we want you to manipulate the renminbi to keep it, stable or high, relative to the dollar. So that's managing its currency. We're telling it to go out and buy $200 billion worth of American goods. This is so it's the state. We negotiated with the Chinese government so for them to tell their companies to go out and buy, goods from American companies. Well, that's not a market economy. That's not what we want, the way we want companies operating. So directionally, that takes us in a wrong direction. And hopefully, like those things aren't. In looking back in a couple of years, I don't know how we're going to hit those numbers and how important it's going to be, but I hope there's more. It gives you at least maybe room to focus on the more important.
But I thought you said it really well when we were talking yesterday, that this kind of deal, it's fine. But it's something that should have been done 3 years ago behind the scenes with the Treasury at that level. It's not the kind of deal that really required, 2 years of a trade war, mass amounts of tariffs. And also, I guess the story that kind of gets undertold is the amount of subsidies that we've provided directly to farmers. I think it's almost $30 billion.
It's amazing. Yeah, I think we could probably look at the latest numbers. I think it's over 30 billion.
Yeah.
And as you noted, I forgot about this because I put it buried in a closet that I don't go look at very often. But relative to the size of everybody, was horrified by the auto bailout, which was around $12 billion.
In the end, it cost us $12 billion. And TARP actually made us about $100 billion.
TARP made money. Yeah. So this sort of bailout of agriculture from a problem that we created, which really is a properly understood. Despite what the president keep insisting that this money comes from the Chinese, it does not come from the Chinese.
Right.
It comes from Americans, whether it's American businesses or American consumers. And we're taking money from one set of Americans and giving it to another set of Americans that are what we call farmers.
Right. And these are just checks. TARP and the auto bailout were investments in those companies. That
actual equity.
This is just a check that goes out every month.
Yeah.
It is worth noting we have talked about the propensity for markets to sort of sell the news, and we really haven't seen that in broad equity markets and so forth with the U.S.-China trade deal, but we definitely did see that in some of the agricultural futures markets. So we saw U.S. soybean futures, cotton, corn. Coming off, they're not falling off the table, but they're down after the release of the details of the deal, because there's a little there's less clarity in terms of what the exact quotas are, how firm the Chinese commitments are going to be, what kinds of wiggle room the Chinese might have to start doing kind of those the market based or otherwise. Decision making with regard to trying to make those numbers work. So we'll watch this space. But the agricultural futures actually gave registered a little disappointment.
Interesting.
But this is good timing too, because we want to see kind of at how serious China is. So I think sending you off to Davos is a good way to find some of those answers.
I'll be back. Yeah, I'll be back in Davos for the World Economic Forum. President Trump will be there, I'm sure. Touting, not just. I think he'll be boasting about the U.S. economy, right? Which is, he has something to boast about.
Yeah.
Right? I mean, he's got a lot to talk about the success of the U.S. economy, and I think he'll be boasting about these trade agreements and what ought to be done about trade. At least that's what I'm expecting. He'll be speaking on Tuesday. I don't think he'll be talking about the theme is stakeholders for a cohesive and sustainable world. Those aren't usually the themes that he talks about. I think it'll be a bit more chest thumping on the U.S. and maybe talking about look, if there is a positive message, I don't know that he'll be effective in delivering it to that crowd. But there's opportunity for a message to say that join us in enforcing some of the rules that we're talking about, and that with respect to China, but everybody, and so that we can go do more trade. Now, I'm not really expecting to see that. I don't believe he is really a free trader. He's not a free trader. He's someone who doesn't think about trade in really, trade economist terms.
Right.
He thinks about it in win-lose mercantilist kind of ways. So I don't really expect to see that, but that's the opportunity that he would have in that setting. So we'll be up in the mountains. I'll report back. We're going to record I'll be recording my portion of the show from snowy Davos next week, and give you some feel and flavor for how those meetings are going.
Yep, I think our topic is set.
Yes, enjoy, travel well.
I will. Any other data we're looking forward to next week? Anything else? Anything beyond earnings? Any big items that we should be paying attention to?
It's not too much on the calendar next week. We've got Bank of Canada and European Central Bank, which will be interesting, but probably no shift in policy. We've got a closely followed economic sentiment gauge for Germany, and we have seen some the improvement in Europe maybe coming off the boil a little bit. We got to watch that. We're going to be also getting a Purchasing Managers Index manufacturing number, a preliminary one for January for the EU and for the U.S. Existing home sales, we'll see if those register another big...
Yeah, compared to our data this week. Yeah, so interesting stuff, but nothing that's going to be too monstrously market moving.
All right, guys. Well, we'll reconvene next week. I'll be coming at you from snowy Davos. Have a terrific weekend. You've been listening to the HPS Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.